a lot of the growth type opportunities, they have a degree of risk, is higher than an income producing deal. If you've got a deal like the one we invested $15 million in Odessa, Texas, it's already throwing off like 11% cash.
What's up, everybody? Welcome to another episode of The Remote Investor. I'm Michael Albaum, and joining me today is an old friend and a very special guest, Paul Moore. Paul is a syndicator, among many other things. And we're going to be talking to Paul today about when it makes sense, if ever, to start getting involved in syndications and what things to be on the lookout for if we are going to take the dive. So let's get into it. Hey, what's going on, everybody? Just wanted to give a quick shout out to BOLDSTREET, which is a prop tech company designed to be the number one place to find and source residential real estate investments. They are going to be able to help you source, find, have access to exclusive off-market properties that you aren't going to find anywhere else on the MLS or on Zillow. So come check us out, BOLDSTREET.ai. Hey, Paul, thanks so much for coming and hanging out with me today. I really appreciate it.
Michael, great to see you again. How are you?
I'm all good, thankfully. It's been a whirlwind of the last couple of years since I last saw you, but all good, man. How about yourself?
Doing great. We're really excited. Our company is launching a couple new funds, and we couldn't be happier.
I'm so glad that you mentioned that, because that's exactly what I want to talk to you about today. We've had a lot of syndicators on the show, and that's something I know that you have done a lot of over the years. So what I want to get your thoughts on today, Paul, is when do you think it makes sense for somebody, an investor, to get involved in syndications as an LP, as a limited partner, as somebody putting money into a deal? When do you think it makes sense for them based on their investment journey, so to speak?
Well, stop me if this isn't where you're going, but Michael, one thing that occurs to me is we have 970 LP investors, and a lot of them are making a lot of money in their day job. There's doctors, dentists, attorneys, IT professionals. A guy called me who had just made $10 million 2 days ago when he sold 20% of his company in Vegas.
Wow.
And these guys, they've seen stuff on HGTV, and they think that looks so easy. Chip and Joanna Gaines did all that in an hour, And the truth is, a lot of them, to be super honest, a few of them could, percentage-wise, a small percentage will probably be okay doing stuff themselves on the side. Mm-hmm. The vast majority, including me, should stay in our lanes.
Yeah. We
should be staying in our lanes doing what we do best. I've only got one rental property left, and they made 7 payments last year. And I just manipulated them into giving me 2 payments when I threatened to put a for sale sign in the yard. But anyway, I'm not a good landlord. I'm being really honest here.
Yeah.
But that's not that's not my specialty. That's why I have other people who specialize in that. And it's the same with doctors, dentists, lawyers. I talked to one of our doctor investors, was like, man, it was Christmas Eve and I was at my church and they were just lighting the candles singing Silent Night. And the next thing I know, my phone blows up. There's water squirting out of my rental property at the neighbor's house. And he had to leave the church and spend Christmas Eve away from his family. Why? He was a doctor, highly paid doctor. And so for most people who want to get into real estate, they want the tax benefits, the income, the appreciation opportunities. They want this incredible supply and demand imbalance in multifamily, mobile home parks now, other things like that. It makes sense for them to invest with syndications or funds that coalesce syndications together. It doesn't make sense for most of them to do this on the side themselves.
Yeah.
Does that answer the question?
Man, it does. And it's funny. I don't know if you saw my face, but I just had this total aha moment, because my response to that was, well, what about leverage and the fact that you can't use leverage to invest in a syndication? But to your point and kind of to your answer, it's maybe the folks that don't need to use leverage to get into real estate are the ones that should be investing in syndications. If you've got $50,000 or $100,000 to be able to invest, you don't need leverage. Maybe that's exactly who this is for.
Well, think about all the people out there who took huge leverage out to invest in deals like Tides Equities or the big ATM deals that were going all around the real estate investing world in the last couple of years. Those people have lost countless tens or hundreds of millions of dollars, and they still have to pay their home equity loan.
Yeah. 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 Okay. All right. I like where this is going. I like where this is going. So we've kind of covered on who this is potentially for. And I would love to hear from you, Paul, about if somebody is going to go get involved in syndications, how should they be thinking about due diligence? Do they need to be looking at the sponsor or the operator? Do they need to be looking at the deal itself? And if so, I mean, you're going to answer yes to one of those questions. How does somebody do that, especially if they're not big or an expert on doing DD? The doctor that makes a lot of money hasn't done DD before. So I'm going to pause and let you answer, but I'm very curious to hear what you're going to say.
At the risk of offending you and your audience, I'm going to be brutally honest here.
I love it.
But I'm going to start with a quote from Charlie Munger. This is a loose quote from what could have been his last interview before he passed away a year and a half ago. He said, "Why do most people think they're going to succeed at actively picking and trading stocks? They don't design their own egg beaters or build their own lawnmower engines, do they?" And the point is, stocks are done for you. You can just click a few buttons and invest. And yet he still says, do you really know enough to do that? Remember, we talked about on another show, Buffett could lose, Berkshire Hathaway could lose 99% of its value and still wallop the S&P 500 over the last 6 decades.
Mm-hmm.
If that's the case, we might want to listen to Munger and Buffett. And they think most people aren't qualified to do their own due diligence on something that's easily knowable, and that is public equities.
Right,
how much harder, I don't want to say infinitely harder, but how much harder is it to know private real estate? Look, every deal looks good. Every website looks good. Every glossy brochure looks glossy. And, it's really hard to figure out. One mistake in cell C137 in a spreadsheet, one error or intentional error is going to throw off potentially the whole thing. How are you going to find that? You're not going to find it.
Yeah.
And so really, that makes me back up and go, okay, if that's the case, how do I pick one? Well, I think one answer to that question is going to be to find the best operator. If you can find an operator with, years or hopefully decades of track record doing the same types of deal that you want to invest in, with a lot of their own money to lose, skin in the game, with a lot of happy clients who reinvest with them over and over and over, year in and year out, maybe you should look at that more than the deal, because again, you're not going to find that error in cell C173, most likely.
Yeah.
I mean, you could rebuild the underwriting model from scratch, but are you really going to do that with hundreds of deals to evaluate? Now, so that's my first answer, is find the best operator. Buffett and Munger talk about, finding the jockey or the horse. And their goal in stocks, or in buying companies, not really stocks, they think of it as buying companies, is to find a durable asset class with a wonderful product with a lot of runway, managed by super competent management team with lots of intrinsic value. Buffett said, price is what you pay, value is what you get. That intrinsic value means there might be a ton of meat on the bone. For example, in California, I know that there are a lot of opportunities to buy houses with a room to put an additional dwelling unit on it. Well, that might be a tremendous value add for somebody. Or self-storage, there could be a self-storage facility where the owner goes, yeah, there's 6 acres out back. I'm sorry, I shouldn't irritate people. Yeah, there's 6 acres out back, and we're not doing anything with it. And of course, the goods operator goes, 6 acres out back. There's huge demand for RV and boat storage or outdoor industrial storage. I can use that and make tens of thousands a month additional money. Value adds, intrinsic value. Find operators who know how to unearth, to recognize and mine that intrinsic value. And I think you've got a better shot than doing all the detailed due diligence on the deal itself, though I still believe you should do both.
Yeah, that makes total sense. And that's, I think, really good takeaway. From the deal itself, are there any major red flags that you have seen in the past and would encourage people to look out for?
Yeah, floating rate debt, for one thing. Overly optimistic underwriting assumptions is another.
Assuming you're going to buy at a 6 cap and sell at a 3 cap.
Oh, that's a terrible one.
It
Yeah.
kills me.
Assuming that the cap rate's going to shrink or compress, meaning that the value intrinsically by itself will go up. We just invested $15 million in our fund in a deal in Odessa, Texas that had verified rent increases of 10% since the deal went under contract. It's just skyrocketing. There's supply and demand's out of whack. And there was an article in the Midland, Odessa paper saying that they believe rent increases in the next year would be 17% in Midland and 13% in Odessa. It was a national statistic that they quoted.
Wow.
They didn't include any of that. Not the 10% they'd already gained, not the 13% that was going to happen in 2025. They didn't include any of it. Now, if they would have included all that, whatever 20-something percent, I would have been a little suspicious of the underwriting, because if that had to happen to make it work, if the risky floating rate debt had to stay at a low rate to make it work, if operating expenses would have had to go down, if vacancy that was at 10% now had to go down to 3% or even stay at 10 to make it work, and if all this together had to happen, and by the way, insurance prices stay the same for 5 years, if all that had to happen to make it work, run away.
Yeah. That's super, super great advice, Paul. And I'm curious, are you seeing a lot of deals still using floating rate debt today, even what has happened over the last couple of years? Or have people gotten a little more gun shy? And I'll go so far as to say is embarrassed to be using it.
I think people have gotten more gun shy, but here's the irony of it. Howard Marks, in Mastering the Market Cycle, said the worst time to buy is right when things look the best. And you can think through that, like right before the top of the roller coaster. The problem is nobody knows where the top is except in a rearview mirror.
Right.
Well, the best time to use floating rate debt, ironically, is probably now. When
rates are likely to go down.
Yeah, rates are probably already hit their cap for a while, and they're going to go down. But even though that's the case, we can't prove that. I mean, let's face it, tariffs and everything might drive inflation back into high gear, and they may have to increase rates again. And they may have to increase them more. There's a long history of that happening. After they've topped, it's gone down a little, and then they went up more. So, yeah, I think people are using it less than they were in the years of frenzy. I have my mentor, who was against floating rate debt, finally caved in 2020 and did a bunch of floating rate debt deals. And he and his investors are paying a terrible price for it now. And I'm so glad I didn't follow his footsteps in that area.
It's hard when everybody is rushing towards something because it looks so good. Like you said, on paper, it's hard to stick to your guns and say, no, this is what I'm doing.
It really is. It's so easy to follow the crowd and so bad to do so. And again, that's why I love reading stuff from Howard Marks, Warren Buffett, Charlie Munger, the value investing crowd. They talk about going against the crowd and not just, not stepping in front of a Mack truck just because nobody else did, but,
right.
With good reason to go against the crowd. Buffett has been the object of mockery and scorn for years. In 1999, when his friends were getting thousands of percent ROIs on their stocks, their tech stocks, he stood up in front of a bunch of billionaires and he said, I know what you're saying about me. I'm 69. You think I'm over the hill. I don't know what I'm doing anymore. And I missed the boat on tech stocks. He said, I'll tell you this, I'd rather invest in Wrigley's gum than your tech stocks, because I know how people will be chewing gum in a decade. I have no idea where the internet will be in a decade. And of course, within a year and a half, he was proven right yet again.
Yet again. Dang. I dig it. I dig it. Paul, I want to ask you about when it comes to structuring a portfolio of syndications. There are syndications for all kinds of different asset classes, as you know, but then also there's growth, there's cash flow, there's for tax benefits exclusively. How do you think about risk diversification and portfolio structuring when it comes to the various different goals of a syndication? Where should people be putting their money?
So I mentioned this guy, I talked to a day or two ago who made it $10 million. He was also saying his wife was a highly paid orthodontist or something. He probably wants more growth for the future than he does income. So if you want growth, if you don't need the income, consider investing in something growth oriented. If you need the income, then definitely you want to be on the income side. All that said, though, let's step back and look at the nature of true wealth. True wealth is not mansions and fancy cars and boats and all that stuff.
What?
I know. It's having assets that reliably produce cash flow. And let's face it, a lot of the growth type opportunities, they have a degree of risk that, is higher than an income producing deal. If you've got a deal like the one we invested $15 million in Odessa, Texas, it's already throwing off like 11% cash. Well, that's probably a lot safer than something that is being built from the ground up and they say is going to throw off 15% cash. Mm-hmm. And, we just know that inherently, but many of us like to try to get that higher return and take that risk. But if you keep playing double or nothing with all your money, you'll eventually land on nothing, and then you'll have to start over from scratch.
That feels like such a big knowledge mic drop. I love that. I love that, Paul. All right, man. Well, let's get you out of here. I really appreciate you taking the time. If people want to invest with you, learn from you, reach out and ask questions, where's the best place for them to get in touch?
They can reach me at wellingscapital.com. That's WELLINGS, wellingscapital.com/resources. If they want to get information on self-storage, mobile home parks, RV parks, just an introduction to investing in commercial real estate. They can also learn more about how we handpick these deals in these different asset classes, these syndications for our investors, so they can just send us a check and they can get, a piece of maybe 50 different deals rather than having to go out and invest 50 different times on their own.
Fantastic. Fantastic. Well, we will definitely link to that in the show notes. Thanks again, Paul, for taking the time. I really appreciate it. And I'm sure this will be not the last time we catch up.
All right, man. Great to see you again.
Likewise. Take care. Okay, everyone. That was our episode. A big thank you to Paul for coming on. Always a pleasure to have him. He is a wealth of knowledge. Definitely check out his website if you are interested in investing in syndications. He has a fantastic track record. As always, we love hearing from you. Ratings, reviews, and comments are really helpful. Send the show to somebody you know that think would want to give it a listen, and we look forward to seeing you on the next one. Happy investing.